Car companies damned if you do and damned if you do not. For the past few decades, especially in America but increasingly everywhere, the prevailing culture in business has been the emphasis on short-term results. Quarterly returns in particular, agnostic of things like long-term planning and the need for intense research and development investments to get ready for the future. There are exceptions to this, of course, especially in the tech world, though that's been less true as of late. But the established car industry is facing a hell of a time convincing investors they can get ready for an electric tomorrow, all while delivering those quarterly and annual financial results investors demand right now. And Volkswagen is emerging as a good case study in that trend, whether it's fair or not. That kicks off Monday's Critical Materials Tech and Transportation News Roundup. Volkswagen's outlook problem, explained. I'll start this off by sharing a Wall Street Journal article published after Volkswagen's annual conference in Berlin last week, which I also attended. Here is how it starts out. Volkswagen is the archetypal legacy automaker. Flabby, slow-moving and valued as if it is going out of business. First of all, damn. That's how you write a lead, folks. It's a little too scathing and represents a conclusion I don't agree with, which we'll get to. But it speaks to how investors view things at VW right now. Most investors don't think very highly of so-called legacy automakers, which have low profit margins, intense overhead costs, and had their viability tested during the Great Recession. Hence the headline on this story, Why Volkswagen is Priced for Failure. Ouch, right? This, even as VW reported a $19.6 billion net profit for 2023. Up 13% from 2022, alongside double-digit sales increases in Europe and North America. A bigger problem is the slowing market in China, which is why VW issued a much more cautious outlook for 2024. But the VW Group's valuation remains quite low, even with highly profitable brands like Porsche, Bentley, and Audi in its portfolio. Example. There are more conventional signs of undervaluation, too. VW stock trades at less than 4 times forward earnings. Toyota, its only peer in scale and global reach, is at 10 times. Chrysler owner Stellantis, which long traded at a discount even to VW, is now at 5 times after a stellar 2023. VW's results offered plenty of reminders why many investors stay clear of the company. Most simply, it made a net profit of $20 17.9 billion in 2023, equivalent to $19.6 billion. While that is roughly twice what General Motors earned, it could be much better. In rough terms, Toyota expects to make 50% more net profit for its financial year through March, even though it sold only 20% more vehicles than VW in 2023. Here is where the damned if you do part comes in. The company is throwing money at the problem, both at new EV partners such as XPeng and at its own Chinese operations. This has long been VW's knee-jerk response to challenges, which doesn't help investors gain confidence that the company will earn acceptable returns. Its research and development and capital expenditures combined will amount to a gargantuan 14% of revenue this year, at the midpoint of guidance, which it insists will be the peak. By comparison, Toyota expects to spend half as much in its current financial year. That is because VW is a company that's committing to an all-electric future, and openly saying its current internal combustion engines will be its last, something it's said for almost a decade now. It hasn't gotten the EV transition exactly right, no legacy company has, yet. But it's listening to consumer critiques, growing its EV market share, and getting ready to face a raft of electric competitors everywhere, including from China. That's where the gargantuan research and development and capital expenditures come from. Again, VW isn't alone here. Ford has the same problem. especially since it breaks out the financial results for its EV division separately, and that operation is burning cash as it ramps up operations. Pivoting to be a battery and software-powered business is a massively costly and complex effort, but if these car companies don't, they're dead in time. So what do investors want here? Returns right now, or a future? The answer, more and more, seems to be both, which may not be rooted in reality. Source: reposted and summarized from Patrick George at insideevs.